Silicon Valley Bank is a financial institution that provides banking services to startups, venture capitalists, and entrepreneurs. The bank has gained a reputation for being one of the top banks for startups in Silicon Valley, with a strong focus on technology and innovation. However, like any financial institution, it is not immune to failure. In this article, we will explore the potential causes and consequences of a Silicon Valley Bank failure. What is Silicon Valley Bank? Silicon Valley Bank, or SVB for short, is a California-based bank that was founded in 1983. It provides banking services to startups, venture capitalists, and entrepreneurs. SVB has gained a reputation for being one of the top banks for startups in Silicon Valley, with a strong focus on technology and innovation. SVB offers a range of services, including deposit and payment services, credit and lending services, and investment services. The bank also provides specialized services such as foreign exchange, treasury management, and international banking. The bank's customers include some of the biggest names in tech, such as Apple, Google, and Facebook. SVB has also provided funding to numerous startups, including Airbnb, Dropbox, and Uber. Potential causes of a Silicon Valley Bank failure. While Silicon Valley Bank has a strong reputation, it is not immune to failure. There are several potential causes of a Silicon Valley Bank failure, including economic downturn. The global economy is always subject to fluctuations, and a significant downturn could have a severe impact on SVB's financial health. Increased competition. Silicon Valley Bank operates in a highly competitive market, and the emergence of new competitors could threaten its position. Cybersecurity breaches. As a tech-focused bank, SVB is particularly vulnerable to cybersecurity breaches. A significant breach could lead to financial losses and a loss of customer trust. Regulatory changes. Changes to banking regulations could impact SVB's operations and financial health. Bad loans. If SVB makes too many bad loans to startups or venture capitalists, it could lead to significant financial losses. Consequences of a Silicon Valley Bank failure. If Silicon Valley Bank were to fail, there would be significant consequences for its customers, employees, and the wider financial industry. Some potential consequences include loss of customer deposits. Customers with deposits in SVB could lose their money if the bank were to fail. This could be particularly damaging for startups and entrepreneurs who rely on the bank for funding. Loss of jobs. SVB employs over 4,000 people worldwide. A bank failure would likely lead to significant job losses. Wider financial instability. Silicon Valley Bank is a significant player in the banking industry, and its failure could lead to wider financial instability. Impact on startups and venture capitalists. Many startups and venture capitalists rely on Silicon Valley Bank for funding and other banking services. A bank failure could have a severe impact on the wider tech industry. Damage to the banking industry's reputation. Silicon Valley Bank has a strong reputation, and its failure could damage the reputation of the banking industry as a whole. Lessons learned from past bank failures. While Silicon Valley Bank has not yet failed, there have been several high-profile bank failures in recent years. These failures offer important lessons for both the banking industry and customers of financial institutions. The importance of regulation. The 2008 financial crisis highlighted the importance of effective regulation in the banking industry. Strong regulations can help prevent bank failures and protect customers' deposits. The need for transparency. Customers of financial institutions need to be able to trust their banks. Transparency in banking operations can help build and maintain this trust. Diversification. Banks that rely too heavily on one market or type of customer are more vulnerable to failure. Diversification can help banks spread their risk and mitigate the impact of potential failures. Risk management. Banks need to have robust risk management systems in place to identify and manage potential risks. This includes risk assessment, risk mitigation, and contingency planning. Customer awareness. Customers need to be aware of the risks involved in banking and how to protect their deposits. This includes understanding the deposit insurance coverage offered by the government and the need for diversification in their banking relationships. Steps to prevent a Silicon Valley Bank failure. To prevent a Silicon Valley Bank failure, there are several steps that the bank and its customers can take. Robust risk management. SVB needs to have robust risk management systems in place to identify and manage potential risks. This includes risk assessment, risk mitigation, and contingency planning. Diversification. SVB should diversify its customer base and financial services to spread its risk and mitigate the impact of potential failures. Cybersecurity. SVB should invest in robust cybersecurity systems and protocols to protect against cyber threats. Regulatory compliance. SVB should ensure that it is in compliance with all banking regulations and laws to avoid potential regulatory penalties and financial losses. Customer education. SVB should educate its customers about the risks involved in banking and how to protect their deposits. This includes promoting the importance of diversification and educating customers about deposit insurance coverage. Conclusion. Silicon Valley Bank is a critical player in the banking industry, with a strong reputation for supporting startups and entrepreneurs. However, like any financial institution, it is not immune to failure. A Silicon Valley Bank failure could have significant consequences for its customers, employees, and the wider financial industry. To prevent a Silicon Valley Bank failure, the bank needs to have robust risk management systems, diversify its customer base and financial services, invest in cybersecurity, comply with all banking regulations, and educate its customers about the risks involved in banking. As a customer of any financial institution, it is important to be aware of the risks involved and take steps to protect your deposits. By working together, banks and customers can help prevent future banking failures and maintain the stability of the financial industry. Moreover, in the event of a Silicon Valley Bank failure, it is important to remain calm and follow the appropriate procedures. Customers should immediately contact the bank to inquire about the status of their accounts and any potential deposit insurance coverage. It is also important to seek advice from financial experts to assess the potential impact of the failure on their overall financial situation. Overall, the banking industry is a critical component of the global economy, providing essential financial services to individuals and businesses around the world. While failures in the industry can have significant consequences, they can be mitigated through effective risk management, diversification, and customer education. By working together, banks and customers can help prevent future banking failures and maintain the stability of the financial industry. In conclusion, a Silicon Valley Bank failure would have significant consequences for its customers, employees, and the wider financial industry. To prevent such a failure, Silicon Valley Bank needs to have robust risk management systems, diversify its customer base and financial services, invest in cybersecurity, comply with all banking regulations, and educate its customers about the risks involved in banking. Moreover, custody their deposits. By working together, banks and customers can help prevent future banking failures and maintain the stability of the financial industry.